Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to this week's Through the Noise podcast, where we put recent market events in context and identify investment opportunities. Now, risk assets have staged a strong rally since the middle of October. The main driver, as we now know, has been growing expectations since the last US inflation release that US inflation may have peaked for the cycle, and which in turn raised expectations that they should enable the Fed to slow the pace of rate hikes. Now, it's not only been risk assets that have rallied, but we've seen long term US government bond yields and the US dollar pull back as well over the past month or so. Now, have we seen the peak in bond yields and the dollar for the cycle? And perhaps equally interestingly, is the equity market rally sustainable? Now, to discuss these issues, I have with me today Rajat, who runs our macro strategy team. So, welcome, Rajat. Thanks for joining us. And let's start with the question that perhaps is at the top of everyone's mind: the equity market rally. Do you believe it has legs, or is this just another bear market rally?
Hi, Manpreet. Yes, that's a big question now, isn't it? So, in a nutshell, we think the ongoing US and European equity market rallies have likely run their course. Benchmark indices in those markets are approaching technical resistance levels. This week's weaker than expected business confidence indicators, and by that I mean the PMIs, imply that the probability of US and Euro area recessions remains high. While investors have cheered a likely slowdown in the pace of Fed rate hikes since October's US inflation data missed expectations, as you mentioned, we believe corporate earnings downgrades are a bigger risk to US and Euro area equities in the coming year as the Fed and the ECB keep tightening financial conditions, albeit at a slower pace. On technical charts, the S&P 500 is testing the key 200-day moving average from where two earlier rallies this year faded. The Euro Stoxx 50 index is just about 2% away from the April high of 4025.
Okay, thanks, Rajat. I think that's definitely helpful from a technical standpoint. But what about the fundamental side? What are fundamentals telling us about markets, and more importantly, what do they mean for Fed policy going forward from here?
On balance, Manpreet, fundamental data continues to deteriorate. US manufacturing and services PMIs fell below 50, signaling contraction in underlying activity for the first time since the peak of the pandemic in 2020. Euro area composite PMIs remained below 50 for the fifth month in a row, although US durable goods orders were resilient, suggesting strong capex. Continuing jobless claims have risen for the sixth week in a row as companies, most prominently in the technology sector, reduce headcount. Nevertheless, we do not expect the Fed to be deterred by initial signs of weakness in the job market. US job openings remain close to their record high, too high for the Fed's comfort, I must say, as high demand for workers is boosting wages at a time when the supply of labor remains constrained by the departure of a record number of 55 plus year old workers from the job market since the pandemic. Next year's job openings, next week's job opening jolts numbers and the non farm payrolls data will be a major focus, with the consensus expecting 200,000 net new jobs created in November. Unless the jobs data underwhelms by a wide margin, the Fed is likely to keep hiking over the coming months, albeit at a slower pace than the last four 75 basis point hikes, with an aim to cool the job market and wages. We thus expect the Fed rate to peak around 5% by June next year. Given this, we believe consensus estimates of around 6% US earnings growth and 1% euro area earnings growth in 2023 are not yet adequately pricing in the coming economic downturn.
Okay, so if we pull that fundamental backdrop together with the technicals you described, what does that mean for investors? What are the investment implications, and how should investors respond?
Yeah, the backdrop I just painted argues for fading the rally in US and euro area equities. This is our key call for this week's market view, and rebalancing into income assets, particularly developed market investment grade corporate bonds, which are now offering a better risk reward balance than equities. They are offering some of the highest yields in a decade almost. For example, our diversified income basket for investors taking moderate risk is yielding close to 7%. We now have a stronger conviction that the US 10-year government bond yield has likely peaked in the cycle. While this does not rule out short term rebound in yields, it strengthens the case for adding exposure to high quality bonds. This also means, by the way, that the broad US dollar has also likely peaked in the cycle, although we still see a near term bounce as the dollar index approaches a key support level, and the euro, which is the counterpart to the big dollar, approaches a key resistance close to 105.
Okay, no, thanks for that. What about China and indeed Asia ex-Japan assets? I know we're a bit more constructive in this area, so can you help our listeners understand, what drives that greater constructive view?
Yes, that's right. In fact, we believe this week's consolidation that we've seen in Asia ex Japan equities and Asia dollar bonds is another opportunity for investors seeking alternatives after fading the rally in US and Euro area equities. While the resurgence in mainland China COVID cases have led to mobility curbs there, likely delaying further easing into spring next year, let's say. Authorities there continue to ease monetary, fiscal, and credit policy to revive growth. We actually expect China's central bank to cut bank reserve requirements after the State Council, which is China's cabinet, signaled such a move this week. This would follow last week's easing of property sector measures and this week's liquidity boost for developers. These measures are likely to put a floor under the depressed property sector. China's Central Work Conference in December is likely to deliver a coordinated plan to revive growth. Given China's sustained policy support, Asia Japan equities, now trading at around 12 times 12-month forward PE, and Asia dollar bonds, which are yielding above 7%, close to their 13-year high, remain attractive, especially for investors with a 6 to 12-month horizon.
All right, and finally, just looking at the week ahead, we have quite a few, key events. I know Fed Chair Powell's scheduled to make a speech, but what are the key events and data points that you're keeping an eye on just over the next week?
Yeah, that's right. I mentioned the U.S. jobs data, and there the one thing is the non-farm payrolls. I mentioned 200,000 jobs. Now we need to watch that one. If there's a big miss, of course, then there is the stronger case for the Fed to go slow from there. Then you have the U.S. core PCE deflator, which, as you know, is the one which is preferred by the Fed to measure the gauge the underlying inflation. The consensus for the core PC is around 5% YOY, so yearly annual change of 5%. Again, uh, big misses or big positive surprises could move markets. Uh, you mentioned Fed Powell's speech. We are waiting to hear from him after all this run up in equity markets over the last 1 month. He has typically come in earlier this year and tried to douse some of those expectations that the Fed will go slow. So we'll have to wait. I suspect, and this is what our team also believes, is that he's going to keep at it, as he said, for now. I doubt whether he's going to be too dovish at this point. And then there's the ISM manufacturing PMI data, which is now signaling, at least the consensus is signaling a contraction for the first time in this post pandemic cycle. And we also need to watch the China PMI data. They have been very weak because of the renewed COVID cases and the slowdown there. Any further weakness is going to further encourage the authorities there to uh, provide more policy stimulus, which should be positive for the risk assets in China.
Okay, thanks very much, Rajat, for that overview. And thank you, listeners, of course, for taking the time to listen to us. If I can summarize the key takeaways from the conversation with Rajat, I mean, a few things, of course, stand out to me. The big one, of course, being that equity is potentially running up against some strong technical resistance. So we'd be biased to obviously use the opportunity to rotate into high quality income assets. The dollar, of course, potentially similar story, but in the short term, at least, could end up bouncing from short term support, and Asia, of course, being one particular region of conviction. So we'll pause it there. Thank you again for listening to us this week, and we wish you a great week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.